I've uncovered 4 stocks with massive upside potential. Most of them are flying under the radar with the rest of the investment world asleep at the wheel, but perhaps not for long. So keep watching to discover the bull case for each. And if you are interested in any of these companies, then be sure to buy them before October, as the opportunity may not be around much longer. Note that my search started with 4,600 stocks and then got narrowed down to 4 that really stood out. One looks so cheap that reaching fair value would mean nearly tripling. Yes, tripling from here. Another has top Wall Street analysts pounding the table on greater than 100% upside potential in the year ahead. And those aren't the only bullish takes you'll see in the video, so be sure to stick around until the end. Let's get right into the first one, which is Century Aluminum with the symbol of CENX. Before we get too far along, I want to briefly introduce myself. I'm Steve Reitmeister, but everyone calls me Righty. I've been investing for over 4 years, and I'm currently a partner at WallStreetZen.com, where a quant rating system identifies stocks with the highest likelihood to outperform the market. And real quick, if you enjoy stock picking videos like this one, then do yourself a favor and tap that like button. It tells the algorithm to put more content like this in front of you in the future. So let's get back to it. Century Aluminum. In plain English, these folks, well, you guessed it, they are in the aluminum business. They run smelters in the United States and Iceland, and they turn raw materials into the metal that goes into cars, planes, defense equipment, and everyday goods. For years, American aluminum smelting was a business in retreat, plants going quiet and production moving overseas. Century has brought key facilities back to full capacity for the first time in over a decade, and they're pushing ahead on a big new smelter in Oklahoma, all riding a wave of U.S. tariff policy that makes domestic production a lot more valuable. This isn't a company riding a 1 or 2 quarter trend. It's a company permanently expanding how much it can produce at home right as trade policy turns in its favor. That kind of shift plays out over years, not weeks, not months. And I have a few more points to support my bullish case here. Looking ahead, the company's revenue is forecast to grow more than twice as fast as the industry average. Now, a lot of that extra cash is flowing straight through to the bottom line. That's because earnings are forecasted to grow 4.5 times as fast as their peers. And here's the value piece that puts the whole bullish puzzle together. Century trades a rock bottom peg ratio of around 0.17. Now, as you probably know, the price to earnings growth ratio, this is a great way to determine how much you are paying for each unit of growth. A peg ratio of 1.5 is about average these days. Anything under 1 calls for steep value, so 0.17 is downright dirt cheap for this stock. Wall Street is also lining up behind these shares. 3 analysts covered the stock, all with strong buy recommendations. The current street high comes from Lucas Pipes of B. Riley Securities, who ranks in the top 3% of all analysts tracked based upon his real stock picking performance. His price target suggests this stock could see nearly 90% upside in the coming year. Now let's run the stock through our Zen Rings quant model, which weighs each stock against 115 different fundamental and technical factors. The results are then distilled down into an intuitive letter grade of A through F. Indeed, you want to pack your portfolio with as many A-rated stocks as possible, as they have historically beaten the S&P 500 by nearly 3-1. Century is just a notch short of that elite A rating, which is reserved for the top 5% of all stocks. Instead, Century ranks in the top 6%, earning a B rating, which is a buy recommendation. But it's so close to A territory that maybe it's better to call it a B+ or an A- stock. You can further dig into a stock's unique strengths and weaknesses through 7 underlying component grades, so let's take a look at those for Century. There are no shortage of standout qualities here. First is financials, reflecting the health of the balance sheet and top operational metrics, which shows up in the top 3% showing of all stocks. Value is a notch better than that in the top 6% of all stocks. That's not just about the PEG ratio. This is based upon 21 different value measures overall, so value across the board. And the standout grade, as it should be for any long-term stock, is growth, the top 1% of every stock tracked in our system. The one knock is a low safety score, which is pretty typical for a cyclical industry like aluminum, where stock prices can be a bit more volatile. However, this stock is in the right place, the right time with the expansion of US-based metal production. This is leading to outsized growth. Now layer on top the extreme value proposition, then you understand my excitement in this first stock. A quick aside before we move on. If you enjoy discovering high potential stocks, then the best thing you can do for yourself right now is sign up for my next live training session this coming Monday. The focus is on timely market insights plus my top picks. Now, it's totally free, but you do need to sign up. Do that now to join me this coming Monday. Just go to WallStreetZen.com/live. Moving on to the second of 4 stocks in National Energy Services Reunited with the symbol of NESR. Now, if you've never heard of it, well, then you're not alone, and that's kind of the point. NESR is an oilfield services company kind of flying under the radar. They're the largest homegrown provider across the Middle East and North Africa. Now, these are folks the national oil companies call for fracking, well testing, wireline, all the technical work that gets oil and gas out of the ground. Their growth isn't riding some unpredictable swing in the rig count. It's locked in. The ramp is being driven by contracted fleet deployments on massive regional projects. Their future growth isn't riding some unpredictable swing in the rig count. It's locked in. The ramp is being driven by contracted fleet deployments on massive regional projects. The developments in Saudi Arabia, expansion in Kuwait, work already signed for and rolling out on a scheduled basis. That's the kind of stellar visibility most energy companies would kill for. And it's showing up in their numbers. They recently posted another earnings beat with earnings more than doubling versus a year ago. Now, some investors have taken notice given strong price action this past year. This would have some investors begging the question if they already missed out on the good times. Gladly, there is ample reason to believe there is still big gains ahead. First, let's remember the growth is already on the books, truly under contract for years into the future. Second is the value picture as we bring back our friend, the PEG ratio we used on the past stock. We are still talking about a very low 0.63 PEG, where shares would nearly need to rise 2.5 times their current levels to match up with the average valuation of a stock these days. Third is the value found by using the discounted cash flow model. That says that NESR is worth around 100 per share, and as of this week is trading around in the mid-30s. So here we're talking about a stock that would have to triple to reach fair value. Now let's dive into the full fundamental analysis provided by the Zen Ratings quant model. Now, NESR does earn the coveted A rating, which stands for a strong buy recommendation. That's because they score in the top 2% of all stocks tracked in the system. Now, this is a truly elite rating, and it's easy to see why it scores so highly as we review the component grades. Financials are the top 19% of all stocks. Then we make a big leap to the top 4% for sentiment, which tracks the smart money interest in these shares. Momentum is top 3, right? A body in motion stays in motion. These are timely shares, and growth is right there beside it, also in the top 3%, which bodes well for more earnings growth ahead. Just like our aluminum company, energy is a cyclical industry. That leads to it being a more volatile stock with every hiccup in energy prices. But none of that takes away from the great visibility thanks to all that contracted growth already on the books. Now you add on top the elite Zen Ratings profile, and it makes it very appealing to load up on this very undervalued stock. Our next pick is one of the most important companies in the entire AI boom, and now it's on a fire sale after a massive and overdue round of profit taking. But a quick ask before we get to that stock: if you're getting value from this video, then hit subscribe and ring the notification bell. That's because I publish data-driven stock analysis like this every single week, and I'd hate for you to miss the next ones. Our third stock is Micron Technology. Okay, no doubt you've heard the company, perhaps one worth reconsidering at this time. They build high bandwidth memory that feeds AI processors data. Plain and simple. Without high bandwidth memory, there is no AI. That is how essential these chips are. Reports just came out the US government is pushing Apple to not source its memory chips from Chinese suppliers. Micron is the largest American memory maker, and it's looking like it will have less competition exactly when demand for memory is exploding higher. This is a pretty straightforward equation for more growth ahead. Probably a lot more growth. Many investors will note the big run-up in shares over the past year and think the party is over. Yet there is ample reason to believe there is a lot more growth ahead. And a big bonus is that shares are cheap right now from just about every value perspective. Let's start with a picture of growth. Their entire high bandwidth memory capacity for 2026 and getting into 2007 is completely sold out. Repeat, completely sold out. You cannot quickly add more capacity in this industry given how difficult it is to produce these kind of high-end chips. So this gives them incredible pricing power with exploding earnings. This is why Wall Street analysts expect Micron's earnings will grow more than 40% a year as we move ahead. That may prove to be on the light side, as this company has beaten the stuffing out of estimates for 13 quarters in a row. Truly mind-blowing earnings momentum on display. Let's turn to the tremendous value equation exposed by the PEG ratio once again. Here it is, just 0.5. Shares would need to triple to reach the average valuation of a stock these days. Wall Street's stance is firmly bullish, given that across 25 analysts covering the stock, the consensus recommendation is a strong buy. Even better is the fair value price targets. Now, on average, they call for about 40% upside. Gladly, we have two analysts who rate in the top 1% on the street in terms of their actual stock peak performance. Folks who actually know what the hell they're talking about. They believe so much in this stock that it has over 100% upside in the year ahead. Indeed, the upside party looks far from over. And the Zen ratings shines brightly upon the stock as well. Micron earns a coveted A rating because it ranks in the top 1% of all stocks tracked, owing to its truly sparkling fundamental profile. Now, as you might expect, the component grades are equally strong here as well. Now, we start with sentiment in the top 17% of all stocks. Value sits in the top 7%. Here again, this is not just about the PEG. This is across 21 different value measures. Momentum in the top 4%, given how strong price action has been, yet still we're getting to buy it on a dip. And then two grades tied at the very top, financials and growth, both in the top 1% of all stocks tracked. Where I have to be straight with you again is safety, which grades on the low side, but that's the real trade-off with Micron and pretty much everyone in the semiconductor space. Memory has always been a cyclical business. It can turn hard and fast, and competition from big Korean players is fierce. That's what leads to that lower safety score because of the higher volatility. But let's take a step back and appreciate the entire picture. Their capacity is sold out. Yes, sold out into next year. And government policy is tilting the field towards American memory producers like Micron. Micron is the AI backbone on this list today. And right now it trades a tremendous discount to fair value. That's a sweet setup that does not sit on the table for long. Our last pick is the smallest company of the day by far and maybe the most interesting. But before we get to it, one quick thing. If you want to stay one step ahead of the market, then join me live every Monday because that's when I share my updated market outlook and trading plan to outperform. It's also going to unveil my trade of the week based upon our proven Zen ratings quant model and my greater than 40 years of investing experience. Now, it's a free event, but you do need to register. Just do that now at WallStreetZen.com/live, or click the link in the description down below, or scan the QR code on your screen, whichever side of me it's on. Just pause the video for a moment to sign up. I'll be patient and wait for you, and I look forward to seeing you there on Monday. The last stock on this list has a market cap barely north of 400 million. It's called Fennec Pharmaceuticals with a symbol of FENC. This one closes out the list for a few reasons. One is, unlike heavyweight Micron, it's relatively undiscovered, and therein lies a great opportunity. Gladly, there's a lot more to like in these shares, so let's keep going into it. This is a specialty pharmaceutical company that makes a drug that protects kids and cancer patients from going deaf, which is a pretty common and unfortunate side effect of a common platinum-based chemotherapy. Fennec's drug is the first and only approved by the FDA to reduce that risk, and they've got patent protection running all the way out to 2039. That's the kind of economic moat I love. A first and only approved medicine with a long runway of protection in a market that's still very early in the game. And the commercial ramp up here is real. Now, after years of losses, they just turned profitable and beat expectations with demand for the drug hitting record highs. This isn't a science project anymore hoping for approval someday. It's an already approved product being adopted faster and faster in the real world. And here's the near-term hook. In mid-September, management is presenting at a major healthcare investment conference, right on the heels of a new real-world data supporting wider use of their drug. That's the kind of moment that can put a small, underfollowed name on the map, and that's why it deserves your attention right now. Wall Street coverage is pretty light, as you would expect for a company this small. That is why it's great to have the Zen ratings quant model to do a deep dive analysis into 115 different fundamental and technical factors. Indeed, Fennec comes out mighty impressive with an elite A rating reserved for the top 5% of stocks. Now, in this case, we're talking about being the top 1% of all stocks. That reflects a truly standout fundamental profile. The component grade shows several strengths worth noting, starting with momentum in the top 18% of all stocks, financial strength in the top 7%, growth top 1%. Note that scoring highly for both growth and financials is one of the best indicators of a company more likely to print more beat and raise earnings reports in the future, which is one of the best catalysts for pushing a share price higher. Yet the standout grade is for sentiment, which sits right at the very top of our scale in the top 0.27%, right? Not even top 1%, 0.2% of all stocks tracked. That means the smart money is already on top of these shares. Now, it's never a bad idea to take their lead on an underfollowed name like this before more people catch wind. There is some downside. It's safety here again, which is what you would expect for a small cap biotech. Plain and simple, shares are going to be more volatile than your average stock. But a first and only approved medicine, patient protection out to 2039, top 1% for growth in the smart money leaning in hard. That's the kind of asymmetric bet that if it plays out could produce one of the biggest winners in your portfolio. So there's your list of 4 stocks built for massive upside as we close out 2026. Now, I want to hear from you. Which of the 4 stocks do you like the most? And is there a big upside stock I didn't mention that belongs in one of my future videos. Share it with our community in the comment section below. And if you want to explore another hot theme, then I strongly suggest you check out my recent video where I reveal the stocks I think could benefit the most from the government's $2 billion quantum bet. It's popping up on your screen right now.